but let's go through this real quick. So tax payments. So we figured out the liability on all of these, and like I said, they may have already paid it. They maybe do a refund. They maybe have to owe additional amounts. We don't know. There are different ways to pay. Most commonly, it's through withholding, but we also have those estimated tax payments that a lot of taxpayers will make. I said normally if you are self-employed, you'll be making estimated tax payments because you don't have withholding, right? A lot of retirees also choose to make tax payments on a quarterly basis. There are calculations for how much should be paid in those estimated payments. The word estimated is in it, so it's not going to be exact, but you want to try and get as close as possible. And the reason for that is you want to avoid any underpayment penalties, because the IRS will assess penalties for all sorts of things. And one of those is underpayment. They'll assess penalties for late payment. They'll assess penalties, so you can have an underpayment of estimated taxes. You can have an underpayment of taxes due with a return. You can have a penalty for late payment of estimated taxes, even if it's just one of the payments. Late payment of taxes due at the end of the year. Just all sorts of configurations of penalties, and that's essentially what you're attempting to do, is to avoid those penalties. You have to pay the tax either way, right? So you want to make sure that you pay enough tax that you aren't then assessed more penalties on top of that. And then if you don't pay the penalties, they'll charge you interest on top of the penalties, and it can be a kind of a vicious cycle there. But those are the two main ways that people will pay, is having withheld from their W-2s, if they get a W-2, or making those quarterly estimated payments. And we're going to talk more about the schedule for those estimated payments when we get to chapter 6, which is about self-employment income, because since it is common for individuals who are self-employed to make those estimated payments. But we'll talk about what's called a safe harbor, where you pay in enough so that you aren't assessed any penalties. So these are, I don't know why they stick this in here. This is one of those refundable credits, so earned income credit. Many people are familiar with the earned income credit. We'll look at it more in chapter 9. It kind of acts, if you're entitled to the earned income credit, it kind of acts like a payment, because it's a refundable credit. Even if you don't have a tax liability, you still get money back. So even if you didn't owe any money at all, even if this tax liability, where are we here, was 0, and you got an earned income credit, you would get that amount back. So it kind of acts like a payment in that respect. Let's see. Okay, so the shoebox of software, this is your first Tax Act problem that you have to work on. This is due next week. You're going to want to go through and read all of this, okay? Because since this is your first time going through, there are step-by-step instructions for you in entering the Tax Act information. So do go through. I'm not going to go through this step-by-step with you. Start working on that. It's not due until next Thursday, but I would start working on that so that you have questions you can come back and ask, and then we can go through some stuff. But I don't want to go through it step by step until I want you to play around with it first and go through this and then have questions. Okay. So this is, you want to read all of this stuff, and it's in your book. Essentially what it is in this first one, like this first part, they kind of describe to you what the process is for completing a tax return when you're a paid preparer, that you get these source documents from a client. So a source document example would be like a W-2 or a 1099 of some sort, or if they're a self-employed individual, it would be maybe an Excel spreadsheet of their income, or even their bank statements, or something that shows what that number should be. Then you input it into the software, which the software then puts it on the correct tax form, provided you've entered it correctly. Garbage in, garbage out, right? You don't do it right, it's not going to come out right. So you're entering it into the software, it's putting it on the correct tax form, and then you get the completed tax return. The final step is always a review. And in tax practice, you always have a separate individual review it. Separate set of eyes, because it's really easy to, you don't want that, it's very hard to verify your own work when you're doing this. And I guess that's the same with any accounting function. Let's see, tax refund, we already talked about this. Tax refund, tax due with the return. The shoebox to software continues here. This is the comprehensive example that you start out with. This is Ed and Betty Davidson. You're gonna enter all this stuff into Tax Act. Their name, it tells you that they're 52. Make up a birth date. Make up a birth date that makes them 52. So whatever year that would be, 1970 something, early 70s. Their address, their social security numbers. How Tax Act is set up is that you enter it in, so they'll give you a copy of the W-2s down here. You go to a form that looks like a W-2, and you just copy the information in. This is Tax Act. Different accounting software does it differently, right? Software that I've used in the past didn't do it like this. It had separate forms where you entered the information, but they give you the document. You're just going to enter everything in just like it is here. 1099 INT, it'll pull up a 1099 INT. You just transfer that information right onto the 1099 INT. And then they just give you all the step-by-step information on how to do that. So they also give you, so there is some taxable interest. Oh wait, no, this is the check work. So there's our taxable interest there, 372. It tells you down here what you should arrive at, but then it also gives you the example. So your final product is that aside from their name is going to include your name, aside from that, it all should look just like this. And you can see they have the digital assets question answered no here. But once you've entered all that in, so you see there's the W-2 information, there's the interest income. It's already entered, the system knows they're married filing jointly, so there's their standard deduction. Here's their taxable income, and then the system does the calculation of what the tax is. For fun, if you wanted to do it, just to check, you could do that. So 2611, there are no credits or anything, so this is all, like I said, line 16 is gonna be the same as line 24 for most of you. Here is the amount that was withheld on that W-2 that is entered on line 25. And so what the system does is it compares what the liability is, where is it, to what was paid, and then it calculates the refund. Okay? And they talk about here, you can get a check, or you can have it directly deposited, or you can apply it to the next year's tax return if you want to do that. Let's see, I don't need to do any of this stuff. Oh, this is just about the due date. You guys all know they're due April 15th, but you can have a 6-month extension for your tax returns if you don't have all of your information. It does not extend the time to pay. You still have to pay what's due, otherwise you're gonna be penalized by the 15th, which essentially means you still have to do all the calculations. But the April 15th, 6 months extends it to October 15th. It has to be postmarked by those days. If you're mailing it in, people don't mail them in these days too much, but if you're mailing something in, it always has to be postmarked by that date. All right, questions? All right, excellent. Well, turn this off.